Welcome to the Merk webinar. The title of the presentation today is Black Swans, where we will discuss the outlook on the markets, the biggest risks, as well as portfolio construction. On today's call, we will have Merk's President and Chief Investment Officer, Axel Merk. Joining alongside Axel will be Nick Reese, Senior Financial Analyst, and myself, Financial Analyst, David Song. At the end of today's presentation, we will have a Q&A. As always, we do encourage questions from the audience, so please feel free to ask us a question at any point during the presentation by typing it into the questions box on your screen. Please also note that this presentation will be recorded. And with that, I will now turn the call over to Axel to begin the presentation. Axel, the floor is now yours.
Thank you, Dave, and welcome everybody. Today's webinar is a little bit different. As you can already see on the topic, we tackle black swans, and as some people have already asked, does that mean all the negative stuff out in the world? Well, there might also be some positive things that might, quote unquote, shock the market. Nick Reese will join me later on a couple of slides, and you'll see a bunch of new slides, not just old cartoons that I will show you, but a couple of charts that we look in the office internally, and we have to go through a lot of material. This was quite a bit of fun, quite exhausting to prepare, exhausting because of all the things that can possibly go wrong in the world. And then, of course, we'll go into what it might mean for a portfolio and so forth. And so let me whiz through here a couple of cartoons that we've published in recent years, because quite often our cartoons are quite much in line with the sort of things that might or might not go wrong in the world. Here there's Big Ben from a couple of years ago who said that this isn't his fault, what's happening in the world, that the world is drowning in money, and now of course as the Fed is trying to extricate itself from these policies, that some of them are crying, and Mr. Bernanke then told the rest of the world to be quiet and not complain. And in this context, here is another cartoon that kind of shows that if everything goes right, everything is perfect, but there is a possible black swan hiding somewhere. And let me show you some. These are continue to be here some cartoons from 2011. Let me show an example here from 2011. As many of you might recall, money market funds were in the news. We were one of the parties cautioning about them. On average, the U.S. money market fund had half of their securities in U.S. dollar denominated debt issued by European banks. Some big firms had 75% of their portfolio, their money market portfolio in such securities, and many of them were Southern European banks. And after we pointed that out, after a few others pointed that out, they reduced those exposures. They still had a substantial European exposure, but then they shifted more towards the higher quality names. And the reason, of course, some of these banks had that exposure is because they were chasing yield like everybody else. Money market funds, as you are probably aware, have very low expense ratios, and in a zero interest rate environment, even with those low expense ratios, well, they can't quite make the money, and so they have to chase yield in order to make the money. And the Greek contagion symbol there underneath kind of symbolized, but yes, this might be a Greek problem, but if Greece has a problem, European banks might have a problem, and with that, U.S. money market funds might have a problem. And so that's just an indication that that we might have some challenges lurking in corners that we might not expect. In 2011, we talked about challenges to liquidity. Now, the context in which we talk about liquidity is different maybe today, but central banks have clearly helped that the immediate liquidity concerns are being addressed, but there's a different type of liquidity issue these days that might give rise to potential black swans. Most notably, Dodd-Frank and other regulations have been discouraging financial institutions from providing risk, from providing liquidity. And so when you historically, or in the recent decade anyway, banks were quite active participants in the market, so they would often take the other side of a trade, and that in itself, while some people in the blogosphere say they are quote unquote manipulating the markets, but if you don't have them, you've got to choose your evil. You just might not have the liquidity out there. Another party that's been taking liquidity away is central banks. With central banks gobbling up the supply of bonds, well, there's just fewer bonds around. And Japan is a good example where the JGB market, the Japanese government bond market, has been all but killed because the Bank of Japan is crowding out everybody else, and well, that just might create some unintended consequences down the road. There's another chart from 2011 where France lost its AAA rating, and of course we can say that this is so yesterday. But if I just take another chart from yesterday, a couple of years ago, we warned about the populist uprising that might come out of the monetary policies. And if you fast forward to the current election cycle, well, I would think that most people agree nowadays that there's a popular uprising. The reason why folks like Donald Trump and Bernie Sanders are popular, in my view, is quite related to monetary policy. And what monetary policy does, and the reason why it is related, is that the wealth effect obviously benefits the quote-unquote top 1%. It benefits the ones that have assets, but it goes way beyond that. When you try to kick an economy into high gear, what you do is you create an oversupply of goods, and that creates high commodity prices. It also produces low inflation for consumer goods. It makes it difficult for companies to have pricing power, and that environment, you get wages that get squeezed, because that's how companies maintain their margins. That's how you accelerate the outsourcing. So aside from the quote-unquote normal globalization you might have had anyway, the policies in place, and monetary policy being a key component of that, have accelerated those trends. And well, the public at large just sees that they're being squeezed. They're unhappy about it, and over time that creates some challenges. And that is one of the reasons why we have in my view, a poison atmosphere where many people are voting toward and heading towards more populist politicians. I'll talk about that issue a little bit more later in the presentation. But for now, I'd just like to point that out, that the political implications of monetary policy are a potential unintended consequence, which can also lead to a black swan. And having said that, some things don't change. We still have too much debt, not just in the US, but also in the Eurozone, in the UK, in Japan, various places around the world. And also, to add to that, there's another thing that hasn't changed. You might recall this discussion about the trillion-dollar coin to circumvent the gridlocked budget. That, well, how do you create money when Congress doesn't allow you to? And ultimately, of course, that coin, for those of you that remember that discussion, was an interlude that lasted a few weeks. I'm not suggesting we'll have a trillion-dollar coin tomorrow, but the reason why I bring up this old cartoon is that I would like to emphasize that you should never underestimate the creativity of policymakers to come up with some very odd solutions to the apparent problem at hand, which of course themselves then might just create another set of unintended consequences. And so it's one of the things when we have an election coming up, or this or that, a crisis somewhere. Well, most of the time, the world continues. And the question is just, how does the world continue, and what does it mean for one's investments? It's not that if the wrong person gets elected, that the world suddenly comes to a stop. And so something will happen. There will be some opportunities, and there will be some threats. And so as an investor, one needs to learn how to navigate those things, and one needs to keep an open mind and maybe also think out of the box if policymakers think out of the box. And the one thing I'd like to mention in this context is that here I say that central banks are not independent. We always hear how independent central banks are, and I think that is a something that central bankers would love to believe. It's something the public would love to believe. Former Chairman Alan Greenspan, and in his honor, we have depicted him here as the sun in the upper right-hand corner, has said that, well, central banks really have to deal with the costs that they're dealt with, and some of it I'm interpreting here, but I'm pretty sure I'm not misrepresenting him. My understanding is that he believes, and I firmly believe, that when fiscal policy is not in order, then it is very difficult for monetary policy to pursue its mandate. And so basically that means if everything is a mess on the fiscal side, well, Greenspan has said that we can promise that we'll pay you your money, but we cannot promise you that that money will be worth anything. And so you can, when you issue your debt in a local currency, you can always nominally pay what it's worth. The problem is, and that's my interpretation, is that when things are not in order, you very quickly have to move towards monetizing the debt. And if you look at the Eurozone, for example, you see that we have ever more creative tools and methods to try to justify the policies. On the small scale, it's something like, oh, we're going to ban the 500 euro notes, so terrorists have less access to money. Well, ultimately, it is about making it more difficult to hold cash, so that it is easier to impose negative rates. At least I allege that. Mr. Draghi at the European Central Bank denies that and says it's only to fight terrorism. But we see all kinds of things here where central banks bend over backwards whenever a crisis comes up. So enough of the cartoons for now. Let's move here to some charts. And here I show the VIX index. And we had early this year, we had volatility flare up. As volatility flared up, asset prices had come down. And most of you that have listened to me in recent months realize that my view is that central banks have compressed risk premia. They have taken fear out of the market, which means that volatility is lower. It means that junk bonds are yielding less. And as the Fed is trying to extricate itself from the policies, volatility should be rising. And as such, we should see headwinds to asset prices. And one of the big challenges in that is, of course, that when, quote unquote, everything has been moving up in price, that we now have, quote unquote, everything deflate. Now, it's easy to say, but if you look at the right-hand side of this chart, the VIX index has been coming down. And so does that mean we're moving back to the complacent territory? Showed you on a previous webinar this chart here for the first time without the beautiful black swan placed here. I believe that in recent years we've moved, as far as the market is concerned, ever more towards the upper left-hand side of these quadrants here. And basically what that means is we're in an environment where volatility is low and correlation across asset prices as assets is high, which means things are moving in tandem. Think about the S&P moving higher and just about all quote-unquote risk assets moving higher, which also means that the traditional way of diversifying a portfolio doesn't quite work, because you don't get the sort of diversification benefit that you historically would get from investing across different asset classes. Obviously, you can still do it, but you've got to be much more careful about it. And we in the office use a slightly different measure than correlation to judge whether one is a complacent territory, but this is for illustration purposes. This makes here the point that if you're in a calm environment where volatility is low and you have good diversification, possibilities by having different sectors, for example, of the S&P move in different directions. That makes for a good classical investment allocation. And what can happen is where we're now, that we're moving between the complacent and the scared environment. The scared environment is kind of the panic mode where, quote unquote, everything is moving down. And that's really the scared environment is an environment where black swans can materialize, in the sense that you can have systemic risk, you can have something that affects the market as a whole because of low liquidity or because of various other things that I'm about to go into about the sort of things, the sort of challenges that could happen. And so if we look here at the classical black swans, I just mentioned two here, and then by the way, throughout this presentation, I'm sure we're not going to mention all of them. There are just too many potential things that quote unquote could go wrong. So as a placeholder, I have their unknown, and that's not because we're missing a bullet point here, but because a black swan almost by definition is something that one hasn't priced in before. We put in the bullet point terrorism before the horrific attacks in Brussels, and well, there are two reasons why we have question marks. One of them is because compliance would like us to put question marks just about everywhere, so we don't have to explain it if we just question it and don't factually state it. But more importantly, terrorism, unfortunately, is something that the market appears to be gradually getting used to. If you look at the market reaction yesterday, that was on Tuesday, when the attacks happened in Brussels, the market didn't really move all that much, and at least not in the immediate aftermath. And unfortunately, that's a sign that we've gotten used to these things. The same with, we used to have the markets react strongly to terrorist attacks in Israel. It doesn't happen these days anymore. Unfortunately, it's just become another item in the news. Now, having said that, clearly, whenever there is terrorism, whenever there's a shock, one does have to think about what might be the broader ramifications. And kind of the typical reaction that one should watch for is that change in consumer behavior. Do consumers go out and shop less? Is there a change in investment behavior? Do companies invest less because they're scared? And so then of course, there are the typical points where you might have an impact, such as in the tourism industry. But as far as this particular incident is concerned in Brussels, the one implication that might have a broader impact is on the British Brexit vote, on the vote that's coming up in the UK about whether to leave the European Union or not. And USA Today asked me earlier today, well, why do I think that might be a reason? And the logic here is the same as Donald Trump in the US is using. Donald Trump wants to build a wall to keep Americans safe, and similarly, the Brits, some Brits anyway, might want to be outside of the EU so that the terrorism doesn't get onto their turf. Now, I would allege that neither in the US nor in the UK, either building a wall or being outside of the EU will really save either country from potential terrorist threat. But that's the public perception that one has to watch if one wants to gauge the risk of kind of secondary shocks that might come from it. Healthcare, just here as a bullet point, is Ebola was an example. It's quite possible that there will be some sort of healthcare that might impact consumer behavior, and of course, always think about that might then impact market behavior as well. Some of these economic black swans that you see here on the slide some of them are the more softer ones that might not be immediately apparent to the markets. As a headwind to economic growth, everything is right, but why the heck does the economy not grow? There's a large number of economists, and we sympathize with that. We tend to agree with that economic growth is held back by over-regulation. That doesn't necessarily mean that one has to kind of say that regulation has to be eliminated everywhere left and right. But if regulation is overly burdensome to comply with, companies spend a lot of time complying with the regulation rather than investing in new business. And also, regulation increases the barrier to entry, which means new business doesn't have a chance to enter. It helps the established business, and the established business, of course, is often, I say of course, I allege it anyway, is not as innovative as new businesses are. So it slows down the innovation cycle, and over-regulation can be a big hindrance to economic growth. Another one is balance sheet reduction. That means that over-levered institutions in particular financial institutions might have a greater interest in healing the balance sheet and getting a stronger balance sheet, meaning getting rid of debt, than to increase in lending. And in that context, I mean, we love to hate banks, but ultimately, if we want to have growth in a credit-driven society, we need to see credit growth. And one needs to balance, of course, the challenge of having a banking system that destabilizes the world versus one that cannot extend a loan. And in my view, there are very simple tools one can apply to make the system safer. Unfortunately, very few of the regulations that have been put in place are working in that direction. Instead, they tend to focus on the first point on over-regulation. Treasury volatility, that's kind of, I put that in the bucket here as well. When you have low liquidity because of higher regulation, you tend to have more volatility in the markets. When you have more volatility in the markets, that's also a headwind towards investment. There's more uncertainty in there. And then maybe that shouldn't be in the bucket of economic black swans. Electronic trading, again, we could have some surprises here because of high frequency trading. I'm not suggesting, by the way, that high frequency trading is bad as such. We could not have modern age exchange traded funds without electronic trading. But the liquidity we see in the markets, part of it might be an illusion. And importantly, one needs to be aware of the implications. So let's talk about black swans that might come from politics. And I'm entering here some very dicey territory. I would like to first say that when you find your friends that are otherwise irrational people utter complete nonsense, odds are pretty high that an election is coming up. And in that spirit, as a full disclosure, I don't like any of the candidates that are on this chart here. And when I look at candidates from a point of view of talking with the public, I look at them from what they mean for the economy, what they mean for monetary policy, and then ultimately, of course, what they mean for investments, the U.S. dollar, for gold, which are our specialties, but for markets in general. And so I couldn't care less from that analysis point of view whether they're for or against abortion or many of the other topics that are, of course, on most people's minds. But in that context, let me just here mention a few things. A Donald Trump, I say here fiscal stimulus, that's also in the context of could there be a positive black swan versus negative black swan? And I'm not going to repeat all the criticism about Trump or most of the other folks here, but it is conceivable that Trump is he likes to build homes, so he might want to build highways. That's kind of a typical populist agenda. Also, somebody who strikes deals is somebody who is willing to spend money. Somebody who strikes deals is somebody who's going to tell their buddy in Congress that, hey, if you vote for my program, I let you build your bridge to nowhere. And so if we had a Trump presidency, that is something that may well happen. Conversely, of course, there's a very real threat of a trade war. What are the implications of a trade war? In my view, the biggest threat to the US dollar in the short term, might come from a trade war. In my view, countries that have a current account deficit, if they impose barriers to trade, less money is going to flow into that country, and such currencies could be under severe pressure. And so that's something to keep in mind. On the flip side of it is Trump is somebody who has indicated that he might provide incentives to have foreign companies repatriate money, so that could be a positive for the currency. Moving on to Cruz. Cruz talks a lot about very basic issues that I don't really want to comment on, but one of the themes that might affect the kind of the sphere that we're dealing with is that he has brought up the issue of the potential introduction of a value-added tax. Now, in theory, a value-added tax, with regard to the sort of things that we focused on, would mean a disincentive to consumption and an incentive to saving more. And so all else equal, that might be a positive to the dollar. Now, having said that, the challenge with a value-added tax is always how it is implemented, how many exemptions you make, and whatnot. If you replace the entire income tax system with a value-added tax system, I think that could be a fantastic idea. The odds of that happening, I think, are very close to zero. We'd end up with both, and we'd end up with the sort of challenges that many critics of the value-added tax system have, most notably that it is an incentive to increase government spending. Now, the positive about it is, with a value-added tax, it's one of the few tools that one has to generate a lot of income, which brings me to a Clinton presidency. With the Clinton presidency, in some ways we might get a status quo. The policies are more closely aligned with the current administration. Having said that, there are lots of spending initiatives that Clinton has, and she's going to finance all of those by closing loopholes and taxing the rich. Unfortunately, there are not enough loopholes around, which, by the way, were introduced by both parties for very valid reasons, and there are not enough rich people around to tax. And so, as far as fiscal sustainability is concerned, I don't think that would get addressed with the Clinton presidency. And Sanders is kind of a Clinton in extreme in some ways when it comes to spending. And I provocatively put here the kumbaya word, because there are just so many spending promises that are made that are impossible to be paid for, in my view. Now, for all of these candidates, we do have to keep in mind that they usually don't get done what they promise to get done. And so we usually get a change in tone, but if Congress doesn't move along with them, they don't get nearly as much done as they would like to. I think one of the biggest threats to fiscal sustainability is if the presidency and Congress are all within the same party, because that means that they can spend money as much as they want to. Because if you pay attention, the Republicans want to cut spending, and they really want to spend it on more worthy causes. And if you listen to the Democrats, they want to cut some of the Republican spending and spend it on more worthy causes. And so, sure, you can say that one is a little bit more cautious on the cost side than the other ones is, but the George Bush years shown that if everybody is in the same house, in the same party, that spending is not necessarily under control. And then, I hope I've offended everybody by now. Just one more thing: the one power that the president does have is that they can have a very strong influence about who is running the various departments, say the EPA or other agencies. And there you can have a huge influence on how much you are pro-business, against business, what sort of policies you pursue. And so within the given laws and framework, there's a lot of flexibility there. So it's a tad more than just giving up on the tone. So this is some food for thought. Let me move on here about kind of black swan as far as the economy is concerned. You see two lines here. They are both different lines that show leading economic indicators that indicate whether a recession might be coming up or not. The gray line are the periods where we've had recession in the past, and then don't neglect the dark gray vertical line that says when the recession was recognized. So usually we are months into a recession before we even notice that we've had a recession. And so I leave it up to your interpretation whether we're tipping over on the right-hand side or not. It's possible, not necessarily, but it is something to keep in mind as we try to untangle here of where we are, and then, of course, what that might mean for the markets if we're in a recession or not. And one other indicator here that's related to where we are in the cycle are the credit spreads. The credit spreads, the higher the credit spreads are of high yield securities versus treasuries, the more risk averse this market is. Again, I indicated that the Fed was compressing risk premia, and if you look there in the summer of last year, June of 2014, risk premia were compressed. That means the lines were low, and then as the Fed has decided they want to move towards an exit, those lines were rising, meaning fear was getting into the market. But at the same time, in recent weeks, we've had obviously quite a pullback in that. Is that just because the European Central Bank is printing more money? Is that because the Fed has done a U-turn? Is it because we have a bear market rally, we're just a relief rally. Is this a change environment? I'm just posing these questions. We discussed those questions internally quite a bit, but ultimately, of course, history is going to be our judge, so I leave that to your interpretation as well. As I say these things, by the way, if you want to have a copy of these slides, please submit that, and we're going to work hard to make those available to you. Here's a chart. If you follow me on Twitter, we've been tweeting this quite regularly to give you an update. The reason we show these FANG stocks, some of the popular stocks that are in the market, is not to give an investment recommendation on any one of those or them as a group, but as a sign of, is this market topping out? Are we going to reach new highs or not? Or are we in an environment where we're going to reach lower lows and the highs are not reaching back to the new highs? Clearly, the judge is open on that, but we are in the camp, as you might be hearing in between the lines here, that maybe stocks are tired, maybe the rally we've seen from the lows are a bear market rally, and that really the downward trend may or may not be broken. And from that point of view, here's a chart of the S&P 500 that it's only since the end of 2014, but to show are we reaching the new highs or are we not reaching the new highs? And at this stage, we're not reaching new highs, and so that might change. But at this stage, I do believe that the bear argument that we made in early August last year when I said I'm coming out as a bear remains in place. Clearly, that argument has been weakened with volatility coming down, S&P going higher. But at this stage, I think the risk is still very, very high that this is a fake rally. Now, what does that mean for investors' portfolio? It means it's not too late to diversify. You've been given yet another chance, and we'll talk about portfolio construction here in a bit. There's another metric here. We don't usually show you this chart, the margin debt balance that we have. Clearly, as the markets grow overall, these numbers might rise over time, and so the absolute value might be less relevant here than the relative value, meaning that are we peaking out here and are we dropping lower? And if you look at the lines below, well, we peaked out in January 2000. We peaked out again and around that anyway. In 07 we peaked out, and we just had another peak. So that's another sign that we might be nearing a peak in the market. Now, maybe Mr. Draghi's freshly minted money, the stimulus he's providing is pushing against that. That might be a question. Just pointing that out here. I will talk about the Asian crisis in a few later slides. And David, please remind me in the Q&A if I didn't get to it. But before I do that, I'd like to hand it over to Nick to discuss, to bridge over to China and explain why China might be relevant for the S&P as well.
Thanks, Axel. So discussing the dynamics in the market, here's a chart that shows in the red line the Chinese currency, the CNH, and that directionally seems to have been leading the S&P since last summer when the Chinese devaluation came into effect on August 11th. That's the sharp drop that you see there in the red line, followed by a correction in the equity market a few days later in August. And I think that what this represents is that the Chinese currency is in some ways a proxy for the fear around China and potentially the fear around a large devaluation coming out of China, which could unleash greater deflationary forces and put further downward pressure on asset prices. So we've seen this be somewhat of a leading indicator and something that we're watching closely internally here as we try to understand these relationships across various markets.
Yeah, I'd just like to add here that earlier this year when we've had the volatility in China, especially also the stock market, go up, I've been in the camp that says China is just a symptom of what's happening in the world, and we really have bigger drivers, the risk premium rising. It's not just a China phenomenon. Having said that, the reason we show this chart is that the market clearly has a view that the Chinese currency and the S&P have a correlation, at least over this period. In the long run, the correlation is not there, but in the short period, that it is very sensitive to news coming out of China. And you might also, if you follow those markets more closely, until the end of last week, for quite a few days, the Chinese currency was rising, indeed was rising back to new highs for the year. And the question was that, well, is it just short squeeze? Is it an attempt by the Chinese government to push the currency up so high to squeeze out the short sellers because they do have quite a bit of reserves. At some points they'll deplete them, but that doesn't mean they can't have a decent shot across the bow and try to discourage them from doing that. Or is China better off? And now, since the beginning of this week, CNH has been falling again, and quite a bit actually, as far as CNH is concerned anyway, for the moves. And it appears, and especially on a day like today, mentioned earlier that yesterday after the Brussels terrorist attack, market didn't react too much. Today it reacted more. Well, it seems today that reality kicked in with, for example, the Brazilian real that had been rallying quite a bit with the potential impeachment there of the president. There's of course a relief rally, but at the same time, hey, the problems aren't fixed yet, and so things are falling back to earth, and that's kind of what we appear to be seeing here as well in China, that reality is kicking in, that things aren't all perfect in China. We'll stay on China on a couple more charts because there are a couple of other points we like to make, since the market in particular thinks that China is so important. So one of them is what's happening in China market-driven, or is it because regulators are interfering in the market? And it is not always easy, or it's usually quite difficult to discern the difference. And one of the things that makes it so difficult to discern is because if you look at the last point that's on this slide, there appears to be, in our assessment anyway, a significant battle amongst policymakers in China. It's one of the reasons you see these announcements coming out that are not so coherent. It's because people are pushing in different directions. And in my view, if you want to attract money into China, you've got to make China an attractive place to invest in, rather than creating hurdles for people to take out money. The Tobin tax, which is a transaction tax, is a step to make it more difficult to invest, which is pushing activity offshore. And so those sort of things are in many ways counterproductive. You have the president in China say that they will continue to open the reform, and those are very nice words, but it would be very, very helpful to actually see actions in that direction. I have very little doubt that in the long run that might actually happen, but in the meantime, we have to worry about investments today. There might be some surprises coming from China. The anti-corruption drive is hindering investments. One of the things we have seen, and we'll go to another slide here in a second, is that the investments are moving from the provinces to the central government. In the provinces, they are afraid, the kind of provincial governors are afraid of making investments because they're afraid of being caught in the anti-corruption scandal. It's no longer fashionable to have big projects happening, and so the stimulus is coming from the central government. And then we'll raise here in a second the question of whether there's just too much debt in China or not. Interestingly, depending on who you listen to, some say yes, some say no. Some say that if you look at the overall debt level, it's very high. There was just a warning coming out from the governor of the central bank that there's too much corporate debt. If you listen to some other very reputable economists, they say, well, the central government has a very low debt level and they have plenty of flexibility of where to proceed. Back to the currency here once more, and Nick is going to explain to you briefly what this chart is about.
So it was, I guess it was a few months ago, surrounding the complaints about transparency on policy with respect to the Chinese currency. Chinese policymakers published this new index that they're using as a reference basket called the CFETS RMB index. That's the blue line. Basically what it is it's a trade-weighted basket of the RMB versus some trading partner currencies, roughly weighted towards their importance for the Chinese economy. In the red is just the Chinese currency exchange rate versus the US dollar. And so what they've said is that on this trade-weighted basket, they're going to keep that relatively stable, and that they're trying to shift the focus away from the exchange rate to the U.S. dollar and towards this broader basket. And what's interesting is that the blue line, this broad basket, had appreciated dramatically starting in the middle of 2014 as the dollar was appreciating broadly around the world in anticipation of, well, I guess during the QE tapering, in anticipation of eventual Fed rate hikes. And the Chinese have kept their currency pretty closely pegged to the US dollar, so it actually appreciated quite dramatically versus its trading partners. Now they're saying that they're going to shift the focus to keeping that basket stable. It's not clear whether that means stable at these elevated levels or stable down at those kind of lower levels where they were before this big dollar bull run. But what we can see is that it's actually, the Chinese currency is actually depreciating versus this broad basket, in other words, versus these other trading partners. Although recently we've seen that that appreciation, at least temporarily, in the Chinese currency, specifically versus the U.S. dollar.
So if I can translate that, one of the things that might just happen is that the dollar doesn't always strengthen. Right? The dollar might weaken yet again, and does that mean that the Chinese are going to allow their currency to appreciate substantially versus the dollar because they're now linked to this basket? I leave that as an open question. I do have my doubts. Let's look here at the Chinese stock markets. There are a couple of indices. We focus here on this particular index. The Chinese market has corrected quite substantially, and the question is the correction over? Now, historically, markets tend to overshoot, but some of the pressure is gone. It's certainly not as strong as it was at the peak. We don't think that pressure is over, but it's one of the reasons why with this reduced pressure, markets might be a little bit calmer because Chinese markets are not quite as volatile. Now, having said that, global markets have not usually reacted very strongly to what's happening in the Chinese stock market. On select days, they have been, when the glass is really half empty, than they have been. It's been more reacting to currency, but of course the market is related to the currency. More relevant maybe to the outlook in China is this chart. This is the Chinese deficit to GDP ratio. And the deficit spending has increased rather dramatically in China. Now, part of that might just be that much of the spending has moved to the central government, and now it's more apparent on the books. But what it may also mean is that, hey, if you have 6% growth, or let's make it 7% growth. Let's have 7% growth, and they have a 3.5% deficit to GDP. It means half the growth is financed because the government is taking out a loan to induce the growth. That might be very difficult to sustain that in the medium term, to kind of push growth that much just through deficit spending. And so when people think about there might be a recovery in China, keep in mind that a lot of that is due to stimulus. And clearly, if that money is invested in a way that's going to lead to fantastic growth down the road, it might be worthwhile. Unfortunately, governments are usually not always the best in investing the money in the right places, but it might also mean that maybe we'll have this slowdown for a little bit longer because the government needs to step in so heavily to keep that growth going. And then I'd like to pass it on to Nick here once more to show a risk that is a bit off the beaten path to some people. We happen to follow it, but that's a sort of risk that you might want to watch out for. And let me have Nick explain why.
So this is the Hong Kong dollar, which has been pegged to the U.S. dollar within a very tight band since the 80s. Basically, it's the midpoint is the 775, or sorry, the low end of the band is 775, and the high end is 785. And it's been trading on the strong end of this band for much of this time period that we can see here, which goes back to the beginning of 2015. And one of the reasons, and during the second half of last year, you can see it pretty much flat up, down against the strong end, and that was basically money looking to leave mainland China, whether it was sort of pure capital flight or unwinding of carry trades that have been put on over time, but that was putting a lot of upward pressure on the Hong Kong dollar. Then at the beginning of the year, basically authorities in China orchestrated this short squeeze against speculators who were betting on a decline in the value of the offshore version of the renminbi, which is the CNH. And they did that by essentially driving up offshore overnight deposit rates, making it very expensive to short the currency. And as traders closed out those positions, they rotated into a liquid proxy, which was the Hong Kong dollar. And I think the general narrative there was that Hong Kong is basically one big banking system for China, and if you have concerns about China, then the Hong Kong dollar might be vulnerable, and speculators went headlong into that, and you could see the Hong Kong dollar depreciating. Upward movement on this chart means depreciation of the Hong Kong dollar. Sharp depreciation there. That's come back, which is an indication that those short positions are not getting rolled. They're getting closed out, and essentially this is sort of a fear gauge for China. That initial spike in fear has subsided, and there's less interest on speculating against the Hong Kong dollar as a currency.
Yeah, and to add to that, maybe there's always an unintended consequence, right? You ban short selling, so people move money abroad. You try to back the speculators, then they speculate the next thing. You can't short European debt in the Eurozone crisis. You short the euro. And by the way, one of the unintended consequences of fighting the speculators, and Nick was quite benign here, the overnight lending rate in Hong Kong was raised to over 90%. That's 90%. Extreme measures. And yes, they preserved the peg to the Hong Kong dollar, but they destroyed the dim sum market. I allege that anyway, because that discouraged people from participating in the offshore fixed income market that is renminbi based. Which is called the dim sum market. Let me move here a little bit faster now through a couple of other things. Government black swans. The government could declare bankruptcy. They often don't declare bankruptcy because there's no proper bankruptcy proceedings. So bankruptcy means different things in different countries. But we haven't fixed the problems we have around the globe. There's still too much debt around, in my view. And could it be that the bond vigilantes in the U.S. wake up? That's kind of that's a reference towards investors selling off treasuries because they're concerned about fiscal sustainability in the U.S. Could Japan monetize its debt? Could there have been some talk about the Japanese swapping or just writing off the debt that's on the Bank of Japan books? And we'll publish a newsletter going into that in more detail in the coming weeks, what that actually means, because some people have said, oh yeah, everything is going to be great and we can live happily ever after. It doesn't work that way. We'll have to address that debt somehow, somewhere, and it's going to continue to be an interesting ride. And as that $1 trillion coin indicated earlier, we might see some creative solutions being proposed here. Here, a quick update on the money printing presses around the world. The top line here continues to be the Fed that has printed the most. Printing means the virtual printing. Bernanke used to call it printing. That's why I use that word. And it is printing in the sense that money is created out of thin air. The central bank, in most cases, buys bonds and just makes a paper entry that now that money is at the disposal. Not all printing presses are created equal. We're comparing a little bit apples to oranges here. But the point is that the Bank of Japan and the ECB continue to be actively adding to their balance sheets. And so they've kind of stepped in where the Fed has left off. The question is that enough to undo, kind of to neutralize that increase in risk premia that I've been talking about? I have my doubts that it does because of the design of these other programs, but clearly it is helpful in creating more liquidity in the world. I think, though, that the markets will topple over nonetheless, but it is something here to keep in mind. Here, just a quick update on the Eurozone debt crisis. The spreads have come down, except, of course, they were higher again in the beginning of the year. And I pause here for a second because I was wondering whether I should mention a specific company in Europe, but I don't have time for all disclosure that would come with that. So let me move on here to the typical black swans is a Brexit or Grexit, referring to a potential exit of the UK from the EU. This morning on Bloomberg TV, I mentioned that if the UK were to leave, the sterling might be a bottomless pit, meaning that the sterling could go substantially lower from where it is right now. It also was suffering quite substantially from the Brussels attack, being kind of one of the main losers in that context because it might raise that sentiment. Brexit is, I think, such a well understood scenario that it might not ripple the markets as much as some people expect. And if it does, it might ripple the markets in very different ways. The departure of a weaker player is going to suck the money out from the weak countries, push them into the strong countries, meaning Germany would suck up the capital, pull it out of the periphery. And so just because you can identify a potential shock doesn't mean you're always aware of what the ripple effects may be. And the third point here, I think, is probably the most underpriced black swan that's out there right now. Chancellor Merkel might not survive this until the election. There's an election coming up in the fall of next year in Germany. She is increasingly unpopular in her policies, and others are smelling blood. They might want to have her seat. Question is what the implications are going to be for the markets when that happens. And with that, let me kind of move here to the dollar as a bigger theme. In the recent newsletter, I showed this chart. This is a monthly chart, so it's the end of February. It's the trade-weighted dollar index, which is published by the Fed, rather than the U.S. dollar index. Primary difference is that the Fed-weighted one includes emerging market currencies, and relative to emerging market currencies, the dollar is substantially higher than the 3-year moving average, substantially outside of 2 standard deviations, and that suggests that maybe it's going to move more towards the trend line. We're not chartists, just putting that out there as something to think about, that all this talk about the rising dollar might be overblown. And then also think about the earlier slide about the renminbi chart. Well, if the trade-weighted basket is going to weaken versus the dollar, is that an excuse that the renminbi can weaken with that, or basket, or is that basket going to increase? Or is that basket going to increase versus the dollar? Which, if that were the case, the dollar would, the Chinese currency would have to appreciate, and I don't think the Chinese policymakers really want to follow through with that. Here's again the U.S. trade-weighted broad dollar index. Has that topped out or not? Again, history is going to be the judge. I happen to think that that it might have topped out, and it might be time to kind of the dollar in portfolios more broadly, and maybe one can do that without taking on equity risk. So then let's talk on political black swans here, going abroad a little bit. We touched on Brazil recently. India might be facing a slowdown as well. South Africa I put on there because we had discussion in the office and somebody said, hey, things might be working better than expected in South Africa. I'm more skeptical on that particular one, simply because the structural rigidities are just so difficult to overcome. And by the way, the same applies to Brazil and India in many ways. India now has a pretty firm hand guiding the country, so they have a better chance of succeeding. Brazil, though, doesn't really have an opposition that's able to induce good reform. The challenge Brazil, for example, has is that a lot of the benefits are indexed to inflation through the constitution. Changing those sort of things is extremely difficult. So for Brazil to dig itself out of this hole requires a strong government, and I don't think there's a strong government available to step in if the current government topples. Saudi Arabia is a black swan to be watched. Saudi Arabia has now decided to issue debt in US dollars. They have amazing deficits. They have been ramping up social spending in recent years to buy social peace. They cannot afford to do that anymore. I allege that anyway. And with that, they're piling on debt now. I think they would be more prudent to issue that debt in local currency, because at some point they will have to do something to try to address that debt burden. It's going to be so much easier to do that if their debt is in their local currency, even if it might be inflationary back home. Commodity black swans, I'm not going to go into all the things that can happen in commodities right now. Just want to mention that if we have a hard landing in China, that might be difficult. Let me mention one thing. It's come up in the news now recently. We've been discussing this for some time. If commodity prices are so low that the cost of production is higher than the market price, it is prudent for companies, for producers to buy the commodity rather than to produce it. And when that happens, of course, you don't invest in new production. At least you have a disincentive to do that. And what that also means that at some point you will have underinvested. And so you increase volatility, and just as you can induce a short squeeze on stocks, you can have quite a squeeze on commodities, not so much from the short squeeze guys, but because you're going to be short of supply, because you have kind of driven too many suppliers out of business. At the other end of the spectrum, IMF intervention, the IMF potentially providing loans to commodity producers is just increasing the agony. We need to take some supply off the market. If we keep them alive through loans, we're just going to contribute to the oversupply. Tainted supply is just a reference towards you could have poisoned milk product or whatever it is. There could be a black swan coming from anywhere. Technological black swans. Cyber terrorism, I think, is a threat that's very difficult to price, but that's something I believe we'll be seeing at some point. The question is, how will markets react, if they can react, if we haven't frozen the markets. Certain markets are more spread. If we have the New York Stock Exchange spread out, shut down these days, the markets can move to other exchanges. Same on the currency side, but the other markets that are very localized, and where not many backups are there. And then coming in a very different direction, I mentioned self-driving cars just as an example, as something that can disrupt industries rather substantially. And then let me move here as we're running out of time here. One black swan that I do like to mention, I mentioned earlier the rise of populist sentiment, and I'm not going to suggest that any one of these countries is going to start a war tomorrow. That's why in the last one here I have ABC XYZ as a general placeholder. But unfortunately, I do not think it is a coincidence that the Great Depression ended in World War II. And we just have populist politicians on the rise, not just in the U.S., where at this stage they're just candidates. We have a populist prime minister in Japan. We have the Labour Party in the UK be led by a populist leader. We have a rise of a populist party in Germany. We obviously have them in power in Greece and a bunch of other places. The one thing politicians in general have in common is they never blame somebody. They never blame themselves. They like to blame somebody else. They like to blame a minority, and that can mean that if you have political leadership do that it can lead to war. And so, unfortunately, I do think that is a scenario that is also underpriced and far more likely to happen in the coming years on a unfortunately even potentially bigger scale. So the question is, where do you hide? Where is safety? And I'm just going here through another cartoon or two. And is it the dollar where you can hide? Is it gold where you can hide? There is no such thing as a safe asset. I say that when we look at gold, because the price of gold is obviously volatile as well. What the price of gold does is it is historically anyway a low correlation to one's other investments. And if you, the kind of one of the themes I've had throughout many of these webinars is that when a central bank inflates asset prices in general, where do you hide? You want to have something that has a low correlation by design. Gold is one of these things. Currencies is another one, especially a long-short currency portfolio. A long-short equity portfolio might be one of those as well. It's not easy to find something that's a good investment or potentially good investment and has a low correlation to what one has. At the very least, investors might want to stress test their portfolio to see how correlated one's assets are. Does everything move in tandem? Here's a chart you've seen before. Gold has done reasonably well during bear markets, with the one exception of the Volcker-induced bear market in gold. It wasn't just a bear market in gold, it was a bear market in stocks there as well, where in the early 80s bear market, gold did rather poorly. In the other bear markets, gold did quite nicely, it did very well, and so gold from that point of view has done great in those sort of environments. So of course no assurance that it's going to do that in the future. I like to put this chart up here on Switzerland simply as a representation that what used to be a safe haven yesterday might not be a safe haven tomorrow, and so that in itself can be a black swan because you don't know where to hide. A quick update on the yen. We were rather negative on the yen for a couple of years. We went out, got public in the 80s, when we wanted to go short, when we went short the yen. We have since said that the yen, while we still ultimately are very negative on the yen, because we are overall negative on the markets, the yen might appreciate again. We came out with that call in December, and since then the yen has appreciated quite a bit and has weakened a little bit in recent days. It is when Abenomics is working, I often say the yen is the yen is losing its quality as a safe haven currency, whereas when Abenomics is not working, it tends to revert to its safe haven characteristics. Obviously, that's a generalization, but it's in that spirit that we look at the yen. It obviously has had a huge run-up of late, and so that's why when you've had these huge run-ups in the immediate future, then it might not behave as you might expect. I'm not going to talk about our funds these days. We will have a webinar on the funds on April 14, our quarterly webinar, and so you're very much welcome to talk about that, to join us on that webinar. The last one, Alpha Opportunities, is not a fund. We will discuss a little bit what we do in-house beyond what we do in the funds, what we currently offer. I will, by the way, be speaking at a family office event tomorrow in Los Angeles. If you happen to be a manager for family offices and are there, send me a message still today or something today, and if we could have you potentially join on that. And then tomorrow evening I'll be speaking in Los Altos at an event. Anyways, is your portfolio ready? And is the pressure cooker, is the lid back on? Is it off? That sort of question that you might want to address. And as you think about it, I pass it back to David, and we're pretty much out of time, but maybe we can have one or two questions. David, please go ahead.
Great, thank you, Axel and Nick. Please now take a few minutes to read the following disclosure as we move to the Q&A portion of the call. Again, I would just like to remind everyone that you could ask a question by typing it into your text box. Our first question is from Russell Irvin, and he asks, by definition, true black swans are unanticipated. What would be your suspicions on gray swans, those which are unlikely but still need to be anticipated and prepared for? And how do you recommend protecting ourselves against the ravages of these black swans? Axel?
Yeah, thanks. Now, great question. I tried to address that in some ways throughout the presentation. Most notably, the way you do it in this environment, in my view, is to acknowledge that asset prices are highly correlated to one another. And as they're highly correlated to one another, you've got to have something that by design has a low correlation to the other assets. And so you've got to stress test your portfolio through general shocks. What is if we have a severe risk-off environment? And got to look at it in the context of all the things that we talked about today, including some others. But one of the key considerations that we value very highly is liquidity. Without liquidity, what happens? And of course, when there's no liquidity and there's a panic sell-off, well, investors will start to sell proxies. So just because you hold the most liquid thing doesn't mean you're going to necessarily be safe. And so that's all I can say at this stage on that. And David, one more question?
Sure. So our next question comes from Thomas Toadman. And he asks, we've heard about the political movements in Portugal, France, and the Brexit, and cashless trend in Sweden. But what is the public elsewhere in Europe feeling about EU and ECB control over their lives? Axel?
Yes. Well, the question is to what extent do people monitor central bank policy? And when the European Central Bank first started on its extraordinary policies, there was a major backlash, particularly in Germany, not so much in the South, although especially the countries that have policies imposed on them by the IMF, they blame the European Central Bank for being the bad boys. They don't blame themselves for having spent too much money in the past. They blame Germany, the ECB, the IMF, the so-called Troika, for all the bad things that has happened to them, and why suddenly they have to pay the bill for all the lavish spending they had in previous years. And if you though fast forward to today, there have been such an array of policies that it has almost muted the reactions. I mean, even if you look at the Bundesbank president, again today, he said, oh, we've moved ever further into uncharted territory. And but at the same time, that's all we hear. We hear a little bit of complaining. We don't like it. You hear it more in Northern Europe than in Southern Europe. And so people have pretty much put up with it. At the same time, yep, there's an interest in gold. There's an interest in alternative currencies. alternative meaning also virtual currencies, and doing things to see what can we do if this continues, because again we haven't really addressed the sort of challenges that we have. And so in that spirit, David, I'll pass it back to you.
Great, thank you, Axel. Now moving to the announcement section of the call, I would like to mention some of our upcoming events. As Axel has already mentioned, we will be having our quarterly webinar on Thursday, April 14th. We will send out event reminders in the coming days ahead, so be on the lookout for that. If you would like to receive a copy of our slides, just let us know through the text box on your screen or send us an email. I know we were a little short on time today, so if we were not able to get to your question today, we will get back to you via email. Should you have any additional questions or comments, please use the Contact Us section of the website at www.merkinvestments.com. As always, feel free to reach out to James at any time, and he'll be more than happy to help you with any questions. And this concludes our call. Thank you, and have a great day.